Hey, good afternoon, students. This is Srini Meka, your instructor for this class. Today is Friday, October 24th, 2025. This is the free cash flow model session two. And right now I have two students, Carissa Hunt and Kenny Hugh. How you pronounce Kenny, your last name?
It's pronounced Wim.
Wen. Okay.
Yeah.
Okay. Kenny Wen. Is it like a Vietnamese name?
Yes, sir. Yes, sir. Yeah,
Oh,
that's right.
that's what I thought. So yeah, I have a couple of students, and these two are my regular online class students, and I have few other students, and happen to be they're not here. But anyway, we first class in the last month, like a Wednesday, we talked about free cash flow for firm and free cash flow for equity, and we calculated, and I did show in the Excel model how to do that. So now, having calculated the free cash flow, and now we project what's the free cash flow is going to be in the future. And based on that, we can analyze and find out the value of the firm. I'm going to give you a beautiful example. This is going to help you. The stuff I'm going to teach you today, it's like a more modeling your company. And when you are outside this class, you could use this template in future, and you can calculate the free cash flow models. So that is the intent. With that, I'm going to share my screen. And as I said, this I'm going to create a model. Mhm. And I'm using the textbooks example. So basically you can take this and imply, and the questions I'm going to give you for the weekend, and that's you can use it. The question has been raised by some of my students is, you haven't worked on my quizzes yet. The purpose of this class is more like a senior level class. As I said, 35%, one third of this your grade comes from the midterm project, and 40% comes from the final project, and the rest of them are comes from quiz. Quiz is about testing your knowledge, and they're like when we are working all the building blocks, how you are working. um, my assumption is you're senior students and you're doing the stuff as we go through. So you target the project work. And now most of you, some of you have not submitted your midterm project yet. So those who submitted, they get full credit. Those who have not, within the time, most likely they don't get the full credit, and that's a given. So please submit before the deadlines. So that is extremely, extremely important because you're senior students. I want you to be more responsible in that part. So hey, having said that, I'm not doing the checks and balances, but I wish you do the stuff ASAP. The other question right now, what we are doing is, and these are the financial models. You can take them home and you can use them. So the anything what we are doing is either dividend discount model or free cash flow model or anything. When we are doing the valuation, we are doing is nothing but cash flow analysis, like a discounted cash flows. So all we are doing is discounted cash flows. So if you are using the dividend discount model, so all you have is D0, D1, and D2, and D3, on and on. So what you are doing is, if the rate of return is R, what you are doing is See, the value of D1 at the present value at the D0 is always D1 divided by 1 plus R. So that you are discounting uh, the value, you are discounting the D1 value at present value of the D0 is D1 over 1 plus R. This is the value here at the D0. And for the D2, if the second year you're getting the D2, the value here at the zero as of today, 2 years from now, that if the value is D2, the value could be D2 divided by 1 plus R square. 1 plus R square. So that's what you're doing. So it's same thing with 1 plus R cube. If you are bringing the third value here, so it is all nothing but this is what we are doing. You're bringing the value here and aggregating what is the D0, D1, D2, D3. Based on that, you're calculating the value. That is the anything discounted models, right? That is what we are doing for anything. Same thing with the cash flow. When you have the free cash flow for firm for equity, for when you are doing the valuation, let's say today it is your company valuation is 0, and tomorrow if it is 1, and basically you are doing that same thing, cash flow discounting. So you put the cash flow 1 in your calculator, cash flow 2, cash flow 3, and you enter the required rate of return and calculates the present value, net present value, whatever. That is the value of the firm. As simple as it is. So there is no difference between dividend discount model and free cash flow model as far as the fact, as far as the bringing the valuation to the present today. Have you guys understood? Did you guys get that picture? Is it clear on that part?
Yes.
Yes, yes.
So it's very simple. That's the reason we did the time value money. That's what we did. So now what I wanted to do is I wanted to share the this material I gave it to you. So like yesterday we calculated how to calculate the free cash flow for firm and free cash flow for equity. That's what we did in this math. So I want you to go back and refer when I give the homework today on the free cash flow models, and I want you to work on that one. But of course, I'm going to give you dividend discount model and free cash flow model questions today, and I don't give too many of them, but so that good enough so that you can submit by Wednesday. So I want you to focus on free cash, dividend discount model and free cash flow model. The reason I did not give the homework last week was I want you to submit your projects to today. So with that said, and let me go back to the free cash flow models. And the one thing I want you to remember, anytime when you go for the free cash flow for firm, when you are calculating the valuation, you need to use weighted average cost of capital. And when you are doing for the free cash flow for equity, you need to use the dividend risk required rate of return, or required rate of return is based on the equity. Weighted average cost of capital. The word is weighted average cost of capital. Cost of capital is weighted both by stock value and bond valuation. So that's the way it works. So for the math, for doing the um, for the anytime you're doing the firm free cash flow for firm, um, you need to use the WACC. Have you guys worked on the weighted average cost of capital?
It's been a minute.
I haven't ever.
You have not? Yes or no?
Have not, no.
You have not. So that's the valuation is always if you are looking for anything equity, you are looking for the cost of equity, the cost of whatever the stock valuation you are looking for. When you are looking for the company-wise weighted average cost of capital, that means the cost of capital it has two components. One company has a debt and another one is equity, right? So same thing when you have a house, you have debt and you have equity, right? When you have the bank loan and you have your own money. Same thing, corporations. It goes like that. So for anything, the companies issue debt. So if the debt is, let's say, 6%, it doesn't cost company 6% because the cost of interest is deductible in the income statement, right? You put like an EBIT, IT, and all that. So you can subtract the cost of interest. But if people like you and I, we cannot take the cost of interest. If you have a credit card debt, let's say 10%, you have $1,000 debt, and last year you paid $100 on the credit card interest. You pay $100 interest when you're filing for taxes, you don't get the deduction. But if you're a company, you had $1,000 credit you used, and you paid $100 on the interest. That $100, what you do, you deduct from your net income, your sales, your whatever the income you get, because you have, let's say you're on 30% tax bracket. So the 30% of that $100 is deductible. So you pay only the $70 payment. So the rest of the $30 you get the money back, because uh, T times one minus T, interest times one minus T, that is your savings. So you don't have to pay that. So the weighted average cost of capital, the formula for that one is weight of your debt, whatever let's say if your company has a 40% debt and 60% equity, so weight of the debt and the required rate of the debt and times 1 minus T. You remember that formula? Whatever the rate, and you are paying times 1 minus D, that is the cost. Because of the tax portion, you don't have to pay I mean, basically you get the tax deduction. That's the thing. And when you, for the equity, the weight of the equity and rate of the required rate of return. That's all the thing. So let's do a math here. There is an example here in this in the textbook. Any questions?
No,
Once
that's
we look
pretty
over
sure.
the textbook version of this example, could
Yes.
we look at the like a cash flow statement from
Yes.
Finance?
Yes. We'll go there.
Okay.
So this is what you see. WACC is weighted average cost of capital, is WE times RE times WD times RD times 1 minus T. You got it? So let's do a math here. Uh, let's do a math problem here. There should be an example. Yeah. I remember there should be an example here. Yeah, here. Yes, sir. There you go. This is one example I wanted to cover. So Napa Valley Winery has a frequent free cash flow for a firm has $5 million. Okay, and debt to equity is 0.25. Okay, let's do this. So Napa Valley free cash flow for firm. Remember, this is for firm. For firm means both the debt and equity involved here. Okay, so how much is that? It's at $5 million. Like the five, 1, 2, 3, 1, 2, 3. So $5 million. That's the free cash flow firm. And it says debt to equity is 0.5. So debt divided by equity is 0.25. So that means debt equals to 1, equity equals to 4, right? This 1 by 4 equals to 0.25. Am I correct? Am I right? Can I write it down as 1 divided by 4, right?
Yes.
So that
Right.
means what is capital then? If debt equals to 1, capital equity equals to 4, what is capital? Capital is nothing but debt plus equity. Am I correct?
Yes.
Correct. Yeah.
So what is capital then?
Assets.
No. If it is debt equals to 1, equity equals to 4, debt plus equity, 1 plus 4 equals to what?
Oh, 3/4, right?
But no, 1 plus 4 is
Five.
5, 5, right?
Oh,
So, so debt means 1 over 5. Can I say 1 over 5, right?
mhm.
0.2. So equity, I can say 4 over 5. Am I right? It's a 80%. Am I right?
Right, right.
So this is 80%. This is 20%. So what we need to do is that the question they gave is, let's read this further. The firm has a tax rate of 40%. Let's say tax equals to 40%. Am I right? So now have they given anything? Anything? Required rate equals to 16. So RE required rate is 16%. And then what did they say? The firm total before and firms before tax uh, cost of debt is 8%. So KD is 8%. So all he's asking to calculate the WAC, weighted average cost of capital. So weighted average cost of capital equals to WD. This is the debt portion. WT, the weight of the debt times rate of the debt times 1 minus T plus and WE, weight of the equity times rate of the equity. That is the formula for weighted average cost of capital. Anytime you do the free cash flow for firm, you need to use the WACC. Anytime for the discounting, for the discounting the rate, you should use WACC. For the free cash flow for equity, FSFE, you need to use required rate of RE, cost of equity. That's what you need to use it. Okay. Now let's calculate the weight WACC. So what is the WD, debt value? What is the weight of the debt? 0.2, am I correct? 0.2 times 0.2 times what is RD, debt cost of the debt is what? What is it? The D 8%. So 8 times 1 minus T, 1 minus what is the tax rate? 40%. Is it right? 0.4, right? And then you go with the plus WE times RE. What is the weight of equity? Equity weight is 80%. So can I say 0.8? 0.8 times what is the RE? 16%. Am I right? I put 16. Bingo. How much you got? 13.76%. That is the thing. Did you get it? So what's the answer here? Yeah, 13.76. You got it?
Yep.
Yep.
Okay. So I'll save this for you guys. Uh, So please pay attention when you do the project. So you need to know all this stuff. So, I mean, it's kind of, I'm spoon feeding. I'm kind of reading the stuff what you have already, what you already supposed to know. That's fine. And then let's go to the problem, what they have given. Uh, so calculate the value of the firm for the value of the per share equity. Okay. Uh, So let's go with the free cash. First, let's calculate for the free cash flow for the firm. the valuation based on the free cash flow for the firm. So let's go with and the question I have here. Yeah, and the expected long-term growth for the free cash flow for firm is 5%. And what is calculate the value of the equity? So let's calculate the free cash flow for firm. So free cash flow for firm, the value free cash flow per the current year is 5 million, right? And it is growing, the cash flow is growing perpetually at 5%. So you remember D0 times 1 plus D0 plus 1 plus G divided by R minus G. So the same formula we use here. Free cash flow for firm 0 times 1 plus G divided by R minus G. Here, instead of R, we use what? Because free cash flow for firm, WACC, am I right?
Yes.
WACC minus G. So that's minus, as simple as it is. So so let's go for the free cash flow for firm is 5 million times 1 plus G. 1 plus 0.05. Am I right? That's the firm is going at 5% rate, right?
Yep.
Perpetually. So that divided by W minus G, the WACC minus G. WACC is a 0.1376, right? 0.1376 minus 0.05. So that gives us close to $600 million. No, $60 million. Am I right? How much they got? Yeah, they got $60 million. That's the firm value, right? So both equity and debt. And all we need to do is subtract the debt, then you'll get the equity value. How much debt the company has. Yeah, firm has a debt $10 million. Okay. So all you need to do is when you calculate your from free cash flow, so all you have the $10 million. That is this is one, I'm missing 10. So then the equity value is, what is the equity value? Equity value, that is for free cash flow for equity. Free cash flow for firm for equity based on the equity value is 59 minus 10 gives you 49 million. But how many shares they have? Are there any shares they gave? Yeah, they have 2 million shares, right? So per share, how much it is? Number of shares is 2 million. 1, 2, 3, 1, 2, 3. So per share value based on the free cash flow is 49 million divided by 2. That comes around 24.5. No, sorry. Gives you $24.97. So based on that company valuation, you can come up with the $24.97. So can you guys understand this, or do you want me to explain it again?
No, I think it's pretty clear.
Okay. Because good. I'm glad I have two people here. So have you got this problem?
Yeah, it was pretty straightforward. Yeah.
Okay, straightforward. Okay, that's good. So I put this as a single stage model. Okay, single stage free cash flow for firm. So this you can refer your class textbook, and I want you to um, I want you to refer to this spreadsheet. When you do your work, I want you to work on that one. So now this is the simple model. Now I wanted to give you one more example, and that way you can uh, so now let's do the another one, two-stage model. So when you do your math, actually this problem I'm going to teach you, this is much more practical. I want you to practice this one so that you understand the math really simple. But in real life example, this is more or less like real life example. So before I do that, before I crunch these numbers, I wanted to make it so simple. Let me read this question and then we can go from there. Okay? Are you ready?
Mhm. Yes.
Okay, this is the one I'm going to teach you, two-stage model. I want you to read this first, but don't worry about the math. I'll walk you through. It makes it so simple. But this is much more realistic example when you go into the industry. These are the things you need to analyze. Okay, let me make it big. Can you see my screen bigger, clear?
Oh, yes.
Because in
Hmm.
sometimes the videos, I watched my own videos, sometimes they don't look very clear. So I just wondered. So okay, here is the problem I'm reading. Calculate the value with the two-stage free cash flow for firm model. Uh, the Prentice Paint Company earned a net profit margin of 20% on revenues of 20 million this year. So 20 million is what? 20 million is what?
Their revenue?
Revenue, sales. So 20% profit margin means what is my net income? Is it like a 4 million? 20 times 0.2?
Yeah, it's 4 million,
Four
correct?
million.
Yeah, okay, there
Mhm.
you go. Fixed capital investments. They say that we calculated the fixed cap and the working cap, right? So here they already gave the fixed cap investment is $2 million. Depreciation, he already gave $3 million. Working cap, 7.5% of every year. So 7.5% of 20 million is what? 1.5 million. So it's like, 1.5 million, right? That is the working capital. Net income, fixed capital, depreciation, interest expense, sales are expected to grow 10% per year for the next 5 years. So once we calculate the first year expenses, the next 5 years, you can simply multiply with the 1.1, right? After 5 years, the growth of the sales and net income, fixed capital, depreciation, and interest expense decline to a stable 5%. So that means the growth is going to continue at the perpetual 5%. That's what it is. The tax rate is 40%. Prentice has 1 million shares outstanding, and the long-term debt paying 12.5% interest trading, and its par value of 32 million. Calculate the value of the firm. It's using free cash flow for firm model. If WAC, he already gave the WCC, WAC value is 17% during the high growth stage and 15% in the stable stage. That's it. Very, very simple. And once we calculate the free cash flow for firm, and we can also calculate the free cash flow for equity and all that jazz. It's not that complex. So let me do this math and then let me put it in Excel spreadsheet and let me go through this. Okay. So here, let me make this a 16 so all can see. So let me put the sales. So basically, I am regenerating the question here. So somebody, do you have the, have you opened the material with you guys? You don't, that's okay. I'm okay if you don't have. So let's go with the year. They gave the first 5 years of the model. So let's go here. Once you do this, it's so simple. You can feel so good. Oh, this is what professor is talking about. 0 year, first year, 1 year, 2 year, third year, fourth, fifth, and sixth is the perpetual. That's the one. He gave the numbers. And let me make this as bold. So we'll make this as sales. So sales, how many millions? 20 million? Am I right? So
Yes.
I'm
Mhm.
sorry.
I said yes.
Okay. So you know the formula for free cash flow for firm is net income plus depreciation, NCC, net non-cash charges, NCC, which is depreciation, plus interest times 1 minus T, minus fixed costs, minus working capital. That simply gives you free cash flow for firm. Am I right? If you remember right, net income, that is a profit margin. That NCC is what? Nothing but depreciation. Am I right? And then you need to subtract interest times 1 minus 3, right?
Right.
Then you need to subtract fixed costs, fixed investments. Then you need to subtract working capital investments. That gives you free cash flow for firm. So let's go to net income. What is the percentage? He said, is it like 20% of the revenue is a profit? So can I say this times 0.2? You guys are good with the Excel, right?
Right.
Yes.
There you go. You guys are great. So now, and what he gave the depreciation, what did he say? Depreciation was 3 million. Let's focus on the first year. So it's depreciation. He gave the number is a 3 million. And interest, he gave uh, how much interest he said? Working capital investment 7%, working capital 7.5, net income and sales are expected to grow 5 years. Where is the interest rate? Oh, long-term debt is 12.5% interest on 32 million, right? Yeah. So the debt is 32 million. So let's do this math. So 32 million and he's paying how much interest? 0.125, 12.5, right?
Right.
And we need to do 1 minus T. 1 minus, what is the tax rate he gave? 40%?
0.4. Yeah.
The 0.4. Is it 2.4 million? Did you get it? You want me
Yeah.
to break it down, these numbers, so you can see.
No, I think I got it just from that. Yeah.
But not you. I don't know other people how they are.
Yeah, I think it would be helpful. Just
Yeah.
lay it out.
There you go. Yeah, because we don't know what other people. Luckily, I know few of you, but not all the students there. So this is information. So let me put somewhere here. This maybe I can call appendix. So what is the fixed investments? He gave already. What is the fixed investment? Come on, Carissa, what is the fixed investment?
2 million.
There you go. What is the W working capital? How much they say?
17%.
Very-
Oh, just kidding. 7.5.
Depreciation was 3 million, working capital 7.5%. Yeah, you're right. 7.5% of the sales. So working capital is 7.5% of sales. So here I put like 0.075, right? 7.5% times sales is 1.5 million. So now it's a simple thing is free cash flow for firm equals to, do I need to put the formula? You can do by yourself. I already did in the last class, right? Net income plus depreciation plus interest times 1 minus T minus fixed cap investments minus working cap investments. That's it. So if I do this equals to this plus this plus this. No, no, my bad. We don't do the sales. Net income plus and interest rate minus and minus this came like the $5.9 million, right? These are the years, so don't get confused. So this is the number we got. This is the free cash flow for firm for zero is 5.9. Did you get it, Carissa?
Yes,
So this is the formula we used, okay?
understood.
This is appendix. Okay. Now, the sales are growing how much? First 5 years. The sales, first 5 years, the growth in the sales and net income, depreciation, all the excess. Yeah. Here, net income, fixed cap, depreciation, interest, expense, sales are expected to grow 10% for the next 5 years. So let's go to net income grows 10%. Sales also grows 10%. That's what he said, right? So this times 1.2, 1.1, right? That's what they said, 10%. And next year 1.10, 1.11. This is what it is, 32 point is. See, this is the growth at 10%, right? Growth at 10% growth. You guys getting this? Is it easy? Complex?
Everything's kind of laid out in the word problem.
Okay. Yeah. Then the net income and fixed capital, depreciation, interest, and sales are expected. So next one is a net income, fixed capital. Okay, let's go to net income also grows 10%. Net in, net income grows. So let's to make it simple because it's a more in dollar terms. Let me put this one. So next one is the you said the depreciation also depreciation fixed capital. Okay. So depreciation and it said the fixed capital also. Have you done the models, guys?
Oh, for free
This,
cash. Yeah,
yeah,
I have.
that's good. That's good. And then the question I have is how much he said the working capital is a working capital equals to 75% of the sales. Has the working capital, has he given any formula? No. So basically he using the same 7.5%. Yeah, this is a 7.5% of the sales. So got it? So we got all the first 5 years. So I'm doing the same math. We found the free cash flow for all the 5 years. You see that? You see how simple it is? It looks complex, but when you put it in Excel spreadsheet, it doesn't look that complex. Am I correct?
Sure.
So that's the thing. So next one, he said, this is we already calculated for the first 5 years. So tax rate is, for instance, 1 million shares. So calculate the firm using equity, free cash flow firm using WACC is 17% using the high growth stage and 15% stable growth. So the next after 5 years, the growth in sales and net income capital depreciation will be stable at 5% per year. So now it's all of a sudden from 10% we drop it to 5%. So this one will go to so we calculate all the way here. This from here it's a perpetual. So from the value from here you calculate it's a D0 D1 D0 times 1 plus G times R minus G. That's the formula we use for this one. You got it?
Yes.
We need to find the terminal value. So that means times 1.05, so 3382. So they're all going by the same thing. So when I do this math, it got 9.98. So we got this one. So these we already known values. This is the projected value. You see this one? I want to make this as red. Okay, this red. Got it, Carissa?
Is that the projected value 6 years from now?
Yeah. See, the 5 years he already calculated. Sales are growing at 5% per year. After fifth year, from sixth year onwards, the growth is going to be stagnant and perpetually it's going to be 5%.
Okay.
So you see this one, right? This is a perpetual growth. This is a
Yeah.
perpetual growth. So perpetual growth of 5%. So now here we need to calculate the terminal value. This terminal value, I mean, this is from here, it's all the future. We need to calculate at the value at the 5. What is my terminal value? The terminal value is always D1 divided by R minus G. Remember in the dividend discount Gordon growth model, the value of the perpetual dividend model is D1. That means next year's dividend divided by R minus G. Remember the same formula here for perpetual value of the free cash flow, the future cash flow at the 5 years. So FC. So let me do this. Terminal value at fifth year is how it is. The future, what is the next year's value is. So let me do this one. So we can say FCFF6, that is the next year, that is D1, like that. That is divided by R minus G. Here, free cash flow for firm, what do you use? R or WACC?
Wow.
There you go, WACC. There you go. So now let's do the math here. Yeah, you got it. You got it. So free cash flow for the next year is 9.98. That divided by WACC. He gave the weighted average cost of capital is at what, 17%?
I think it was,
17. Yeah, 17%. So 0.17 minus growth is 0.05, right?
yep.
0.05. So if you do this math, the value, the perpetual value based on that was 83. No. Actually, he gave the two things. Sorry. So he gave the two WACCs. Calculate the value of the firm at the equity free cash flow firm model. If the WACC is 17% during the high growth stage, that means first 5 years is 17%. And
Okay, so use
15%. Yeah, I think you're right. I did not. This is a 15%. That's what we need to use. So instead of 17, we need to use 15. I got it? So
Yes.
so here WACC permanent WACC long is 15%. So that's
Will
what.
you zoom in just a little bit? I'm sorry.
I'm sorry?
Will you just zoom in on your spreadsheet just a bit?
Yeah, sure.
Thanks.
Yeah, my bad. Actually, that's good. I'm glad you asked.
That's good.
That's good? Okay, sure. So the number here, instead of, yeah. So the value we got here, $99.8, $99.8 million. Got it?
Mhm.
So now let's do the cash flow model, free cash flow model. So
Wait, I have a question.
yes,
Sorry.
yes, ma'am.
So obviously our model in front of us, these numbers are in millions for the
Yeah.
sake of the word problem.
Yeah.
Now, the 99.80 that we calculated, is that also in million?
Yeah,
Millions?
yeah. That's 99. See, the next year cash flow is a 9.98. And the next year it's going to be 5% and 5% more, 5% more. It's going all that. But the value at the fifth year, based on the sixth year onwards, so this is like a D1. If it is a D0, this is D1. So perpetual value is always D1, that is next year's dividend divided by R minus G, right? In the dividend discount model.
Mhm.
Same thing with the free cash flow model. For the next year onwards, it's a perpetual, right? So from sixth year onwards. So the value from sixth year onwards at the year 5 is next year's value divided by R minus G, right? WAC minus G here in this case. You got it?
Yes.
Did you get it? Understand?
Yes, yes, sir.
No, no, I'm Carissa.
Oh,
Yes.
sorry.
Okay, okay, that's good. So now let's go to the CF. Now based on these cash flows, this is current year zero. So based on here, what is the free cash flow we need to calculate, right? So now CF1, we know CF1 is 6 point. Do you have a calculator with you, Carissa?
Yep.
So now CF2, um, sorry,
Let me get there. Hold on one second.
yeah. CF2, you have HP, I think 7.14. And yeah, CF3 equals to 7.85, and calculate the free cash flow for firm 8.64. And CF5, you need to calculate two of them, right? One, the years 5, and the two is a perpetual value. How much is the perpetual value? 99.80. So this is the amount. So that comes around what? 109.3. Am I right? 109.3.
I'm putting these cash flows right now into my list.
Yeah, 109.3. So calculate the present value, NPV. And what is the R you use? What is the required rate of return?
What do I put for CF or cash flow 5?
Yeah, 9.5. And you
Okay.
have the perpetual value of 99.5. So that add together, it comes like 109.3.
109. All right, I've got all those input.
And what is the WAC value use? R value, I value, whatever. What is the
5%?
discount? I'm sorry?
And we're using 5%?
No, 17. That's the growth. WAC in the exponential growth first 5 years, he gave uh the calculated value of the firm, it's equity of the using free cash flow. If the WAC is 17% during the high growth, so
Okay.
first 5 years it's a 17%. So you need to use the WAC as 17. Got it?
Am I using that as I? Sorry, I'm following along with the calculator.
Yeah. That's right. That's right.
Okay, I've got that input as I.
So what did you get the present value?
MPV 82.04.
No, you're wrong. It should be around 70.
I mean, calculator, net present value,
Yeah. What did you get?
82.049.
Mhm. Did you use clear your calculators?
Yes. I can run through it one more time just to ensure, however.
Yeah, there is no CF0. Don't put CF0. Kenny, have you found anything?
No, sir. I'm a little confused myself.
Why are you confused? I need to know.
I'm still not familiar with using the BA calculator.
I got it. 70.12.
There you go. You got it. Yeah, that's the way it should be.
I never know what to put for cash flow zero sometimes.
Yeah, because you're not giving anything cash flow. Just ignore the cash flow. That's all for the first year. Because you're calculating the future cash flow, the
Got it.
value of the future as of now. So that's what we care for.
Okay, that makes sense.
So what happened before, we really don't pay too much attention. We don't pay attention to that.
Heard.
It's based on the what's the future, right?
Got it.
So 109.3, I'm doing myself, and NPV, it's asking for 17%. Compute, I got 17.13, 70.13. Yep.
Yeah, round it up. I think
Yeah.
my decimals are 0.127, so
Yeah. You're right. You're right. Exactly. So that is the free cash flow for firm. Got it? And um, so how much debt they have? That is the 70.13 million value. But how much debt company has? 32 million. So this is free cash flow firm is both the debt plus equity, right? So now how much debt we have? 32 million, right?
Right.
So if you take the debt out, what is the equity value? 70.13 minus 32. That gives you, this is the equity value, right? Equals to 70.13 minus 32 million. It gives you 38.13 million. That is the value of equity. Equity in this is in millions, right? But yeah, that is the value of the equity. Yeah. Actually, we're going by per share. Yeah. That's what it is. Yeah. So based on that, you can calculate the value of the firm. So I think so right now you have done the free cash flow for firm model. So I want you to, when we do the next project, but I'll help you. But I'm spoon feeding you guys. Hey, but hopefully you get the point how to calculate the free cash flow for firm, the valuation of the company based on the free cash flow models. You know the valuation based on the dividend discount models. Now the valuation based on the free cash flow models. So what I do is I'll give some homework today, and there will be some questions based on the dividend discount models and free cash flow models. They're very, very similar the way you do the analysis. So I want you to do work a few problems there and submit it by Wednesday. And next week, I'm going to cover more equity analysis based on the dividend discount models, free cash flow models, and relative valuation models. I want you to get familiar with that, all three areas, and your final project, that is what I am targeting for. You make a nice report using your midterm project and these free cash flow models and all that. And by end of the class, you should be able to give a presentation and value your firm easily. And I know it looks complex, but I'll make it simple. But as long as you do my midterm project, submit by end of the day today, and I also start working on quizzes. I know some of you are interested to know your scores. I'm going to give you ASAP. So by next week, you'll have your scores ready, and also you'll have the midterm grading ready. So with that, if you have any questions, I'll keep it open. Otherwise, I'll stop the recording. Any questions, Carissa?
No, sir.
How about you, Kenny?
No, sir.
Okay, with that, what I do, I will stop recording.